By early 2026, Dubai's luxury property market had seen price growth of more than 70% compared to parts of 2020. The Skyline still looked unstoppable. New towers kept rising. Billionaires kept arriving. But underneath the glass and artificial islands, something started feeling strangely different. In certain districts, lights stayed off at night. Some luxury apartments remained empty for months. Reports suggested transaction activity in parts of the high-end market had begun slowing after years of explosive momentum. And that creates a dangerous contradiction, because cities built on constant expansion rarely know how to behave when the flow begins to slow. For years, Dubai looked like the ultimate modern success story. Between 2021 and 2025, the city experienced one of the fastest luxury real estate expansions in the world, fueled by foreign capital, tax advantages, and a wave of ultra-wealthy migration. The UAE economy grew steadily through multiple periods during that cycle, while Dubai's population reportedly expanded by hundreds of thousands of residents as new investors, entrepreneurs, and remote workers arrived. Penthouse sales crossed tens of millions of dollars. Branded residences linked to global luxury names kept launching almost monthly. In 2024 alone, analysts estimated Dubai recorded billions in high-end property transactions, with some waterfront districts seeing price increases exceeding 20% year over year. Everywhere you looked, the message felt the same. This city had cracked the formula. Luxury malls stayed full. Restaurants remained booked weeks ahead. Cranes dominated the skyline from downtown to Palm Jumeirah. And perhaps most importantly, global wealth started treating Dubai not as a temporary playground, but as a long-term safe zone for capital. That belief changed everything. But by late 2025, some analysts began noticing smaller signals that did not match the confidence on the surface. In certain luxury segments, transaction volumes appeared to slow, even while new listings continued rising. Reports from parts of the market suggested buyers had become more selective, especially as prices in some prime areas climbed far beyond pre-2021 levels. At the same time, thousands of additional residential units were still moving toward completion across Dubai's expanding development pipeline. And that matters, because supply can keep growing long after demand starts losing momentum. The visible signs were subtle at first. More vacant balconies at night, quietly offered to renters. More ultra-luxury projects competing for the same pool of global buyers. Even some investors who entered aggressively during the boom years reportedly started shifting behavior from rapid flipping toward cautious holding. The skyline still looked alive, but underneath the momentum, confidence no longer felt automatic. The deeper concerns started appearing inside the numbers. Between 2022 and 2025, Dubai attracted enormous waves of foreign capital into real estate, with luxury property transactions reaching tens of billions of dollars across multiple reporting periods. Russian wealth relocation, European capital diversification, crypto gains, and global tax migration all helped fuel demand at the top end of the market. In some prime districts, prices reportedly surged more than 15 to 20% annually during peak periods. But rapid appreciation creates its own pressure, because eventually, affordability stops mattering only to middle-class buyers. It starts affecting investor psychology too. In 2026, analysts estimated that tens of thousands of new residential units were scheduled for delivery across Dubai over the following years, including a large concentration in premium and luxury categories. That introduces a difficult equation. If supply rises faster than fresh capital inflows, pricing power can weaken very quickly. Construction costs also remained elevated compared to pre-2020 levels, driven by labor, materials, financing pressure, and infrastructure expansion. Developers still launched projects aggressively, but some investors began questioning whether end-user demand could realistically absorb the pace of growth. Meanwhile, rental yields in certain areas appeared to compress as acquisition costs rose faster than rental income, and that changes investor behavior fast. Because once buyers stop expecting rapid appreciation, the market narrative shifts from scarcity to competition. Some reports also indicated that transaction activity in selected luxury segments had started normalizing after the explosive post-pandemic surge. Not collapsing, just slowing. But highly leveraged growth models do not always need a crash to create stress. Sometimes, momentum fading alone is enough, especially in a city where expansion itself became part of the identity. For many residents, the shift was no longer just visible in investment reports. It was showing up in everyday life. Between 2022 and 2025, rents in several Dubai districts increased dramatically, with some areas reportedly seeing jumps of more than 30 to 40% over relatively short periods. International schools raised tuition fees, restaurant prices climbed, service costs increased. Even mid to upper income professionals who once viewed Dubai as financially efficient began quietly reassessing their long-term plans. And that creates another layer of pressure beneath the luxury narrative, because cities built around global wealth still rely on workers, operators, managers, and skilled professionals to function. Some families reportedly started relocating farther from central districts to reduce housing costs, while others began negotiating remote work arrangements or shorter residency plans. The towers still looked glamorous from the outside, but underneath the skyline, daily life was becoming noticeably more expensive. And when living costs rise faster than stability, behavior starts changing long before headlines do. One major cause appears to be the sheer speed of expansion itself. During the post-2020 boom cycle, developers accelerated launches across almost every segment of Dubai real estate, from ultra-luxury waterfront villas to branded high-rise residences. In multiple reporting periods, analysts estimated tens of thousands of new units were scheduled for delivery simultaneously. That creates a structural risk. Because real estate markets can absorb high prices more easily than they can absorb oversupply. Another pressure point came from the type of money entering the city. A significant portion of Dubai's surge was fueled by globally mobile capital seeking safety, tax efficiency, and asset diversification during periods of geopolitical uncertainty. But international wealth moves quickly. By 2025 and early 2026, some investors appeared less focused on long-term ownership and more focused on liquidity preservation. And when capital becomes cautious, transaction momentum can slow surprisingly fast. Interest rates also change the equation. During earlier years of the boom, cheap global liquidity helped fuel aggressive buying behavior across many international property markets. But as financing conditions tightened globally through 2023 and 2024, borrowing costs increased and investment calculations became less forgiving. Even cash buyers were affected indirectly because higher rates tend to reduce speculative appetite worldwide. Dubai was not isolated from that shift. There was also a behavioral factor many people underestimated. For years, Dubai's growth story depended partly on perception. The idea that prices would continue rising because demand would always expand. But once enough buyers begin wondering whether the market is near its peak, psychology changes. Some investors hold back, others delay purchases. A few quietly exit. Built on confidence can become vulnerable the moment confidence stops compounding. Finally, the luxury segment itself may have become too crowded. By early 2026, branded residences, ultra-premium towers, and high-end communities were launching at a pace that even wealthy buyers could struggle to absorb fully. Exclusivity works best when supply stays limited. Once luxury becomes abundant, the entire value equation starts shifting. To be fair, many analysts still believe Dubai remains one of the strongest global wealth hubs entering 2026. The city continues attracting entrepreneurs, hedge fund managers, crypto investors, and multinational businesses at a scale few regions can match. Tax advantages remain powerful. Infrastructure is modern. Tourism numbers have stayed high across multiple periods, while the UAE continues positioning itself as a long-term center for finance, technology, and global mobility. From that perspective, temporary market cooling may simply look like normalization after an unsustainable surge. But others see rising vulnerability beneath the optimism. Rapid price appreciation, aggressive construction pipelines, and dependence on international capital can create instability when global conditions shift. Some investors appear increasingly cautious about luxury oversupply and slowing transaction momentum in selected districts. And this raises a difficult question. Is Dubai entering a healthy stabilization phase, or the early stages of a much larger adjustment that few people want to acknowledge yet? The answer may depend less on buildings and more on behavior. Now, many investors seem trapped between two uncomfortable choices. Staying in the market could still generate long-term gains if Dubai continues attracting global wealth at its current pace. Some prime areas may remain resilient for years, especially assets tied to limited waterfront land or ultra-high net worth demand. But if supply keeps expanding faster than fresh capital enters, owners could face weaker rental yields, slower resale activity, and increasing competition across the luxury segment. Exiting carries risk too, because leaving too early in momentum-driven markets can mean missing another major wave upward. And Dubai has repeatedly surprised skeptics before. That is what makes the situation psychologically difficult. The Skyline still projects confidence, the headlines still celebrate growth. Yet underneath the surface, some investors appear to be asking the same quiet question. What if the real danger is not a crash, but getting stuck in a market that slowly stops moving? What is happening in Dubai may reflect something much larger than one city. Over the past decade, global wealth behavior has changed dramatically. Capital no longer moves only toward traditional financial centers like London or New York. Increasingly, wealthy investors are chasing mobility, tax efficiency, political stability, and lifestyle infrastructure all at the same time. Cities became assets themselves, and Dubai mastered that model faster than almost anyone else. But the competition is evolving. By 2025 and early 2026, other regions across the Middle East, Asia, and Southern Europe also began aggressively targeting global capital through residency programs, luxury developments, and low tax incentives. At the same time, younger, wealthy buyers appeared more flexible about where they live, work, and store money. Loyalty to one location became weaker, and that changes the future of luxury real estate globally. Because the next phase may not be about owning the tallest skyline, but about keeping capital emotionally confident enough to stay. In that environment, perception becomes almost as valuable as the buildings themselves. Dubai's skyline still shines brighter than almost anywhere on Earth. The towers remain full of ambition, money, and global attention. But history shows that cities built on rapid expansion often look strongest right before momentum becomes difficult to sustain. By early 2026, the question was no longer whether Dubai succeeded. It clearly did. The real question is whether the system underneath that success can keep absorbing endless growth without consequences. Because once investor psychology changes, even slightly, entire markets can begin behaving differently. Slowly at first, then all at once. And maybe that is the strange feeling people are starting to notice beneath the glass towers. Not collapse, not panic, just uncertainty. The kind that usually appears before the next major shift. So what do you think? Is Dubai simply evolving into a mature global capital, or are the first warning signs already hiding in plain sight?